a coffee shop. Sarah, a financial analyst, and John, a bank customer, are discussing the impact of inflation on deposit money.
Hey John, it's great to see you. How have you been?
Hi Sarah, I'm good, thanks. I've been trying to wrap my head around this whole inflation thing. I've noticed my savings aren't going as far as they used to, even though I'm earning interest on my account. Can you explain what's going on?
Sure, I'd be happy to help. The issue you're noticing is due to inflation. Inflation is when the overall level of prices for goods and services rises over time, reducing the purchasing power of your money. Even if you earn interest on your savings, if the inflation rate is higher than your interest rate, the real value of your money decreases.
So, even though my bank account shows that I'm earning interest, I'm actually losing money?
Exactly. Let's break it down with some numbers. Say you have $10,000 in a savings account earning an annual interest rate of 1.5%. If the annual inflation rate is 4%, your real return is minus 2.5%. This means that, in terms of purchasing power, your money is worth 2.5% less each year, even though the nominal amount has increased.
Wow, that's pretty discouraging. Why do banks offer such low interest rates if inflation is higher?
Good question. Banks operate within the broader economic environment influenced by central banks, like the Federal Reserve in the United States. When central banks increase the money supply by lowering interest rates or through quantitative easing, it stimulates economic activity but can also lead to higher inflation. Banks follow suit and reduce the rates they offer on deposits to maintain profitability since they make money by charging higher interest rates on loans than they pay on deposits.
So banks benefit from this, but depositors like me lose out.
Unfortunately, yes. Banks benefit because inflation reduces the real value of the money they've lent out, making it easier for borrowers to repay loans. Additionally, rising prices can increase the nominal value of assets like real estate, which banks hold as collateral, improving their balance sheets. Plus, banks operate under a fractional reserve system, where they are required to keep only a fraction of their deposits as reserves and can lend out the rest. This practice further increases the money supply, contributing to inflation.
That doesn't seem fair. Is there anything I can do to protect my savings from inflation?
Absolutely. There are a few strategies you can consider. One approach is to invest in assets that typically outpace inflation, such as stocks, real estate, or inflation-protected securities. For example, Treasury inflation-protected securities TIPS in the US adjust their principal value based on changes in the consumer price index, providing a hedge against inflation.
But aren't those investments riskier than a savings account?
They can be, which is why it's important to diversify your investments across different asset classes and geographic regions. Diversification helps manage risk and improves the likelihood of achieving returns that exceed inflation. It's also crucial to stay informed about economic conditions and central banks' monetary policies to make more informed decisions about your savings and investments.
It sounds like I need to do more than just leave my money in a savings account.
Exactly. Savings accounts are great for short-term goals and emergencies, but for long-term growth, especially in an inflationary environment, you'll need to consider other investment options. Historically, periods of high inflation, like the 1970s in the US, showed that keeping money in low-interest accounts led to significant losses in real value. In 1979, for example, the inflation rate peaked at around 13.3%, while average savings account interest rates were significantly lower. This disparity led to a substantial loss in the real value of savings.
I see. What about more recent times?
Even more recently, following the 2008 financial crisis, central banks around the world, including the Federal Reserve, implemented policies to keep interest rates near zero to stimulate economic recovery. While these policies helped revive economic growth, they also resulted in low returns for savers. For example, in 2020, the average interest rate on savings accounts in the United States was around 0.05%, while the inflation rate was approximately 1.4%. This resulted in a negative real return on savings. Additionally, with the economic disruptions caused by the COVID-19 pandemic, central banks continued to keep interest rates low to support recovery, further eroding the returns on savings.
This makes a lot more sense now. It feels like a double-edged sword. What else can I do to safeguard my savings?
Besides diversifying your investments, you can also consider adjusting your savings strategy based on your financial goals and risk tolerance. If you're saving for short-term needs, keeping some funds in a high-yield savings account or a money market account can still be beneficial. These accounts might offer slightly higher interest rates compared to regular savings accounts, though they might still lag behind inflation. For long-term goals, explore other investment vehicles like mutual funds, index funds, or exchange-traded funds ETFs, which have the potential to offer higher returns that can outpace inflation over time.
That sounds like a good plan. How do I get started with these investments?
It's important to do your research or consult with a financial advisor to understand the best options for your specific situation. A financial advisor can help you assess your risk tolerance, set realistic financial goals, and create a diversified investment portfolio. They can also provide guidance on rebalancing your portfolio as market conditions change, ensuring that you stay on track to meet your goals despite inflation.
Thanks, Sarah. This has been incredibly helpful. I feel more confident about taking steps to protect my savings now.
Anytime, John. Remember, staying proactive and informed is key to managing your financial health, especially in times of economic uncertainty. If you have any more questions or need further advice, don't hesitate to reach out.
I will. Thanks again for all the insights. It's good to know there are ways to mitigate the impact of inflation on my savings.
You're welcome, John. Take care and good luck with your investments.